Thank you, everyone, and good evening. Thank you for joining us today for part one of our financial empowerment series. I would like to begin by acknowledging that we live and work on the traditional territories of many Indigenous nations across Turtle Island. While we meet today on a virtual platform, we must recognize the importance of the land and our treaty agreements. We acknowledge the ancestral and unceded territories of all Inuit, Métis, and First Nations peoples. As our Spinal Cord Injury Ontario community encompasses many geographies, we ask that everyone take a few moments of their day to find out which unceded or treated territories you may live and work on. You can use the link www.native-land.ca to learn more. My name is Julie. I'm a peer support coordinator for Spinal Cord Injury Spinal Cord Injury Ontario in the London region. I'm co-hosting these series with my colleague Brett Babcock. He is also a peer support coordinator in the Ottawa region. So this is part one of a four-part financial empowerment series. And we're very lucky to have all four sessions presented by our own community member, Sean Leduc, a licensed financial broker and educator. So Sean, I'll pass it over to you to introduce yourself and take it from there.
Awesome. Awesome. Well, thank you so much, Julie, and it's a pleasure to be able to be here with you guys and kind of share some of my knowledge. And throughout this educational series, we're going to be talking about a lot of different things. And truthfully, there's probably going to be a lot of different questions. So please feel free anytime, whether it's through the chat, anything that I know Julie, Brett, and myself can do to support you, we're very happy to do so. So what we're going to do today is we're going to chat a little bit about tax strategies, and then a lot about disability specific accounts. So truthfully, we had a tax accountant that was supposed to come tonight, but unfortunately I found out this morning that she had a close family member that passed away. So she's unable to be with us. So, thoughts and prayers are with her family during this tough time. But it's crazy how something like that happens when we're sitting here for a financial empowerment series. That one of the things we are going to talk about at the end of the series, or near the end of the series, is, legacy planning, estate planning, whether it's different insurances, different things that we can have in place for our family for, when that kind of stuff does happen. So what we're going to do is I put together a little presentation. Can everybody see it okay? If I can just get a couple of thumbs up, that would be great, just so I make sure. Fantastic. I love the virtual thumbs. They're fantastic. My light makes it kind of look like I have a halo, which is a little weird, but we're going to go with it. So why this matters to me, and I'm going to share a little bit about my journey. So 3 years ago, I had spinal cord surgery, a failed spinal cord surgery that changed my life instantly. I needed surgery because I stepped on a baby toy and herniated the disc in my back. And then shortly, about 6 months later, I slipped on a grape in a grocery store, and that really did it. So I needed to have emergency surgery because they were concerned that I'd lose my ability to walk. And the surgery kind of made that a reality really quickly. I walked into surgery with really bad sciatic pain, back pain, and I kind of woke up with no movement in my lower half of my body. And I know that a lot of you are facing very similar challenges. So for me, my story has my story's not finished, but I have a very blessed turn in my story. So I lived in a wheelchair for almost 2 years. So I understand the struggle that many of you face physically, mentally, and the hidden financial challenge of a disability. I understand the accessibility issues that when many of us are trying to get into, local restaurants or local stores, God forbid, go to Mont Tremblant. That was wild. I tried to do Mont Tremblant in a wheelchair, and I ended up going back again, which was even crazier. But it was one of those things that it opens your eyes that most people wouldn't see. So I'm super blessed. I've regained some mobility, and it's really fueled my motivation to help others navigate the system that I want to say I survived because I'm kind of optimistic about it, but it's a system that I'm still fighting in. So, I still battle a spinal cord injury every day. Um, Although my walking is something that I can do better than I could 3 years ago. It's something that I still do face some challenges with and stuff like that. And obviously, the pain is, which many people here probably can understand, the pain is pretty constant and doesn't usually go away. So, wanted to kind of show you a little bit of my family. So on the bottom left, that is my amazing girlfriend and my absolutely precious daughter, Paisley. She just turned 4 years old, and she's my whole life. I was a single dad until I met my girlfriend, and it's been such a blessing. So, the next picture is me with my little pup in my chair when I was out and about and going for strolls. I always thought it was really important for my mental and my physical health, to make sure that I continued to get out and about. The next one is my daughter and I actually, about what would that be, 10 days ago. We were going to public skating, and her smile just was radiating. So I had to put it in here. And then the next one was my girlfriend and Paisley doing some acrobatics, I guess you can say, at the gym. I am nowhere close to being able to do that kind of stuff. But it's amazing to get to have somebody that treats my daughter like her own, and gives me the whole world, and supports me through, whether it's through my pain, whether it's at home, at work, with my restrictions and stuff like that. It's a pretty big blessing. And then the last picture was probably our nicest picture together, and that was at her sister's wedding, which was pretty cool. So that's a little bit about me. And the reason I shared that is because I want you guys to know that I'm not somebody that's sitting here that's talking about all of this, but not having to experience it. I've been through a lot of challenges that, many of you have gone through. I've seen the accessibility issues. I still do see the accessibility issues. I've seen the mental struggles that come with it. I see obviously there's many physical challenges. But then when it comes to financial challenges, there's so many different ways that a disability impacts people, which many aren't aware of. And truthfully, it feels like the government isn't aware of it either sometimes, because there's still obviously a lot of things that we have to cover out of our pockets. So we'll kind of jump into it. So when it comes to tax credits, I'm going to call it the master key. Is when I was kind of putting this together, I was like, what do we call the disability tax credit? Because it is essentially something that gives you access to an ample amount of other things. So essentially, the disability tax credit this year in 2025, the tax credit is $10,138. So to be able to write that off on your taxes is massive. So that's one reason to get it. The next one is it allows you to have access to the Registered Disability Savings Plan, also known as an RDSP, and the brand new the Canadian Disability Benefit. So RDSP, Canadian Disability Benefit, we'll kind of get into a little bit more later. I'll speak to the Canadian Disability Benefit a little bit now. So the Canadian Disability Benefit, what this is this is a benefit from the government that allows anybody that has the disability tax credit to get up to $2,400 a year. So if you have the disability tax credit, you are automatically eligible for the Canada Disability Benefit, and it's up to $200 a month, and that is based off of your income, if that makes sense. When it comes to disability tax credit, so many people ask me, well, what diagnosis do I need? If I have this diagnosis, is that the right one? Am I going to get it? Am I going to get the tax credit? How does that work? 90% of the time, it's not about your diagnosis. It's about the time it takes you to walk. It's about the time it takes you to get dressed. It's about, how you manage your bowels and your bladder and what is day-to-day life care in. It's a lot of those ADLs, if that's probably a term that is very familiar to many faces on here. The other big thing with the disability tax credit is called the 10-year retroactive rule. And this is such a blessing. So if you've had your disability for 10 years, well, anytime between now and 10 years ago, essentially what it is the government will refund your taxes. They will do the taxes for you, redo them, and then give you a refund once you have your disability tax credit for your taxes up to the past 10 years, if that's how long they give you the disability tax credit from. So what I mean by that is when you get your disability tax credit, it will essentially say you have been eligible from 2016, let's say. And then what they would be able to do is go back for your 10 years in taxes and be able to do them. And then you would actually get a lump sum deposit in your bank account or check, depends how it is with CRA, which is super cool. The 10-year rule also applies to an RDSP, but we'll talk a little bit about that later. The other amazing thing about the disability tax credit is that if you don't pay tax, this can be transferred to a supporting family member. So where this comes into play a lot is if there is a child with a disability. So if there's a child with a disability, a lot of times the parent will be able to utilize this tax credit. So at this time, you'd want to have the higher income parent to be able to maximize the return for the disability tax credit. So the other thing about a disability tax credit is that it's either given for a range of time or for life, if that makes sense. So I know for mine, they had given me a 10-year period that my disability tax credit will be active. So after that 10-year period, there's a review to see if I'm still eligible for the disability tax credit. A lot of times people with spinal cord injuries, truthfully, it's a very explainable injury and stuff like that. So when it comes to disability tax credit, it makes it easier. So the next thing comes into play is regards to medical expense tax credits. So it's the METC. So essentially what this is the total expenses minus 3% of your net income. So that's not gross income, that's net income, just to confirm, or $2,834, whichever is less. So this medical expense tax credit, and what I did is I put in some examples for people with spinal cord injuries. So if we need incontinence supplies, so catheters, etc. If we need modifications for a vehicle, so if we need modifications for a vehicle to help us be able to drive, all that kind of stuff, they will actually cover up to 20%, up to $5,000 for the van modifications. We can do, and then you can write off the rest in regards to this. Home renos, if you need ramps, walk-in tubs, different things like that. And then travel for medical care. So if you are traveling over 40 kilometers one way, then they will cover the dollar, like they will cover the portion of the dollar amount for that. So the big tip and strategy for this one is when you're to do this claiming, if you're submitting taxes with somebody else, claim all of the expenses on the lower income spouse's return to hit that 3% threshold faster, if that makes sense. Again, if you have any questions just reach out to me, and I'm more than happy to clarify things, or kind of get you in front of those right people that can potentially help you with your taxes. So next, we're going to talk about the $90,000 opportunity, which I'm going to call your future. This is leveling the financial playing field through strategic inclusion. So the $90,000 opportunity is the RDSP. So we're going to really get into some depth in regards to the RDSP. So how the inclusion math works, and I apologize, I pressure release a lot when I sit down. So I'm a little bit, I move a little bit, so I apologize about that. But how the inclusion math works. So every year, if you are under 93,000 and change, if you make under $93,000 and change, the government will deposit $1,000 into a savings account for you, which is awesome. And this savings account is called the Registered Disability Savings Plan. So they will put part of the bond, they will put up to $20,000 in your lifetime into this account, which is pretty cool. This account has a lot of caveats, and there are age, I don't want to say restrictions, but there are at certain ages, certain things in the disability savings plan become more advantageous, certain things work differently. So we'll kind of go through all of that. And one thing that we'll talk about, and I think it's on the next slide, so I'm going to jump to the next one. Actually, so the next one goes into grants. So how this works is, so like I said, the government will put $1,000 every year if you make under the income threshold. And then what they will do is that if you deposit into this account, the government will put, for your first $500 you put in, the government will match it 300%. So you put $500 into this, and the government will put $1,500. So the next $1,000 is matched with $2,000. So we're going to talk about essentially what happens with the RDSP, because this is something that's a little bit more for retirement, because this is not something that can be, the government puts in money and it can be accessed right away. The government's, all of the government's contributions have to vest for 10 years. So the other thing I do want to add is in regards to the grant is the government can go back up to 10 years. And the maximum that they can contribute in a year is $10,500. So I'll give you a personal example. I opened up my RDSP in March of 2023. I, in my lifetime, have put in $4,500. I just looked the other day. My personal account is at $26,843. For me, that's a good start for my retirement. That's going to help me when I retire. It doesn't affect ODSP, nothing along those lines. But essentially, in regards to the government going back to 10 years, for the 10,500, you put in 4,500, they would match the 10,500 if you have the trailing space. So there's also the invisible asset, and this is what I call this, is the invisible asset means that the RDSP is 100% exempt from ODSP asset limits. So the RDSP maximum that can be contributed in a lifetime is $200,000. So so essentially that's $200,000. But if there's investment growth, that doesn't cap out at $200,000. So when you withdraw from the RDSP, this does not claw back your monthly support that you're receiving from ODSP, CPP, OAS, anything like that. So put a couple stats in. So as of December 2024, only 34% of Canadians that have a disability tax credit that are approved for the tax credit from age 0 to 49 actually have an RDSP. So with that said, if for $125 a month, which is $1,500 a year, you aren't just saving for a rainy day. you are essentially building a $750,000 legacy simply by leveraging the government's matching system and the power of compound interest. So how I did the math on this one is that if you were putting in $125 a month, this obviously changes depending on your age, but if you have the space to do that for 20 years, let it vest for 10, let it grow, all that kind of stuff. So if, this would be a perfect example for somebody that's 30 years old. They're able to invest for 20 years, put the $1,500 in, and then they're probably looking at close to $750,000 by the time they are 60, which is amazing. And the cost of not getting an RDSP, and again, it all depends on your age, and we'll kind of talk about that in the next slide. But if somebody is 30, 40 years old that has the retroactive 10 years, you could be losing out on up to $20,000 that the government is willing to give you, which is pretty cool. So this is actually hilarious because when I was making my slideshow the other day, I had made the cost of waiting, and then this was pre-populated in the slide. And I was like, wow, all these people look like they're waiting. I'm going to keep this in here. That's pretty fun. So what I always say is the biggest mistake isn't investing it poorly. It's never showing up to collect the money. The government sets aside this money for everybody with the disability tax credit. And as seen on the last slide, only 34% of people access this. So the bond reality. If you are low income, which is under 93,000, I'd have to check the exact number, it's 93,000 and change. If you are low income, the government puts $1,000 a year into your RDSP automatically for up to 20 years. The math of silence is what I call it, is if you qualify but don't open an account, you are effectively choosing to lose up to $20,000 of guaranteed capital. And the age 49 cliff, which we will talk about. I've seen it coming a couple times in the chat about, turning 50 and all that kind of stuff. Once you turn 50, the quote unquote faucet for the bonds and grants is off forever. You are not going to get any more grants. You're not going to get any more bonds. You can still save your own money, but the government's $90,000 essentially of support ends. So where this gets creative. So let's say I want to look at this because not everybody in here is going to be under 30 years old. So late to the game, here's the catch-up strategy. So the 10-year rule. So if you are given access to your disability tax credit for the last 10 years, if you are currently 40 and just learning about this today, again, you don't have to panic. You can catch up for the last 10 years and miss the grants and bonds in one go. So for example, I had a client last week who just got his government match in, and he put in $1,000 into his account to start. After his government matches and his government bonds, he now has $19,000 in his account, which is super, super cool. So essentially in a year, they can get you up to 11,000 in bonds. So what that is the previous 10,000 for the previous 10 years and the 1,000 for this year, and then 10,500 in grants in every single year by utilizing the carry forward. That makes sense. The win for this is you're essentially teleporting yourself 10 years of savings into an account in just to a few years to catch up, which is really cool. And then here is the reason, because so many people come to me and they're like, Sean, I'm over 50 years old. There's no reason for me to open up an RDSP. But there actually is, which is pretty cool. So just because you're not eligible for the bonds and grants, it doesn't mean that you can't open it. And what I say is open it anyways. Why do I say that? Is because it's the only account in Canada that is invisible to ODSP. It's the only TFSAs, RRSPs, non-registered accounts, everything like that, visible to ODSP. And if you have over $40,000, then you lose your ODSP entirely, which is crazy. So why the benefit of this? If you ever come into an inheritance, if you get a gift, if there's a legal settlement that happens, you can put up to $200,000 into an RDSP and essentially tax shelter it. That money will not count towards your ODSP asset limit, which is $40,000, and the growth remains tax sheltered. It protects your monthly support while allowing your wealth to grow. So how I look at this is essentially what you are doing is, let's say you have over $40,000, you're over 50, and you get an inheritance. The inheritance is for $100,000, let's say. If that inheritance goes into your bank account, ODSP is done. If that inheritance goes into your RDSP, ODSP continues. You can withdraw on that $100,000 from your RDSP. Nothing happens to your ODSP. So there's really big advantages for people, even if you are over the age of 50. It's a good way to tax shelter. Again, all your growth is tax free. So that's definitely a big advantage for that. So what we'll chat about next is we had talked a little bit about TFSAs and RRSPs. So a TFSA is essentially the accessibility fund. So why I say this is you have wheelchair repairs, you have an emergency, you have a car breakdown, anything like that, you're actually able to withdraw from your TFSA, no penalty, no taxes, nothing like that. How much you withdraw out is how much comes into your bank account. So what a TFSA is a tax-free savings account. So what this means is that the money that you're putting into this account has already been through the tax phase of stuff. So for example, your income that goes into your bank account, it's usually already taxed. So then you put in your tax-free savings account, it grows tax-free. And then when you take it out, there's no taxes. The other option is called an RRSP. This is a registered retirement savings plan. So essentially what this is a tax referral. So a lot of times what happens is people with jobs that pay a bonus or a commission, they're sometimes able to put their commission into an RSP so that if they're getting a $10,000 commission, instead of only getting $6,000 in their bank account, they can get $10,000 in their RSP. This is usually good for high income earners, but here's the disadvantage, is there's a couple. One, if you take any withdrawal from your RSP, it's calculated as income. Two, if you do a withdrawal from an RRSP, what happens there is that it's actually taxed. So in regards to, you have your $10,000 you put in, you're getting $6,000. So what most people tend to do is an RSP is essentially meant for retirement. So what that would mean is that most people are essentially withdrawing from their RSP once they hit retirement because their taxable income is the lowest, because they're usually retired, they don't have a job, all that kind of stuff. So for the disability community, in my professional opinion, the tax-free savings account usually beats the tax-deferred RRSP. And again, it can all change on everybody's personal situation. One of the things I will mention in regards to this, and why I think it's really important to look at your options, because so many times your TFSA or RSP, if somebody says that, the first inclination is, I'm going to go open one at my bank. Where it's funny to say, and I'll explain why in a second, but that's actually not in your best interest. And why I say this is because it's actually beneficial to find a financial broker that doesn't work with banks. Or when it comes to working with banks, doesn't get the bank's returns. So, and the reason I say that is because what happens with the banks is I'm going to use the example of $10,000. Let's say you have $10,000 in a TFSA at the bank. So what the bank's going to do is the bank is going to say, okay, we will give you 1% return, 2% return, whatever it is. The bank is then taking that $10,000, they're investing it, and they're making 8, 10, 12% on that. And what they're doing is they're giving you back 1 to 2%. So if the bank made 10%, they're giving you 2%, then essentially what's happening is the bank is making 8% on your money. So your money's not working hard for you. Where a lot of financial brokers, and this is something that I do with families all the time, is we show you how, when it comes to a tax-free savings account, how to get your money working harder. Your investment makes 10%. How about that's in your pocket? Why does that need to go to the bank? Because let's be real, the bank makes enough money as it is, which is a lot. So what I essentially do, one of my main things is I show people how to, make their money work harder for them, and take that money that was going to go into the bank's profits and put it in your pocket, which is pretty cool. So, as one of the things we like to talk about is something called the rule of 72. So, what the rule of 72 is it means that every time that your investments hit 72%, and so if your investment, and I guess the best way to explain this is if your investment grows 7.2% for 10 years, then what that means is that in 10 years, your money will double. If your investment grows 10% for 7.2 years, in 7.2 years, your $10,000 in this example will double. So if we are to look at, when I ran the numbers the other day, it was 123 years at the bank for your money to double, or you could be looking between 7 and 10. And so that's the big perk of going and seeing a financial professional that is outside of the bank. So we're really lucky here, and I know we're getting a bunch of questions in the chat, and I'll see if I can jump back here. So I'll add one more thing before we kind of finish off, talk a little bit about our next session, and is that there's more accounts than just a TFSA and RRSP. There are first home savings accounts. There are registered education savings plans. All of these have different perks to them. So a first home savings account is like a TFSA, but you get the RSP tax benefits, which is pretty cool. And that's for somebody that hasn't owned a home in the last 4 years. There's education savings plans, which are savings for kids that go to school. The government will put in contributions every year, all that kind of stuff. They'll match your contribution, everything like that. Those are just some different accounts that you could, benefit from and stuff along those lines. But realistically, if we're looking, and I guess this is probably a good way to put it, is that if you're looking for your retirement, an RDSP, the disability savings plan, is really a really, really great way to go. Again, you can't touch it. You can't touch any of the government money for 10 years after they contribute it. So if you are 35 years old, you make a contribution, the government puts in, they backdate it, they put in 10,500. You can't touch that until you're 45 years old. Once you're 45 years old, you have full access to it. So it follows up again year after year after year. So that's why they usually say you contribute up till 50, and then 50 to 60, it's what's called vesting. And then at 60 years old, then you start withdrawing from your RDSP. So what I'm going to do next is chat a little bit about next week, and then we're going to open up the floor for some Q&A. I saw a bunch of Q&A, so I was hoping to have about 20 minutes to do it, and we'll be able to do that. So Next week, it's going to be on March 9th at 6:30, and this is going to be foundations and income support. So what we're going to chat about here, we're actually bringing on a special guest who is a staff lawyer out in Renfrew, Ontario, and she runs a pilot program to help people get on ODSP in her region. So she knows all the ins and outs of the ODSP application process, what she sees, what to fill out and what to not fill out. As surprising as that sounds, there are some things in the ODSP application that you do not want to fill out that she will talk about. But essentially navigating that black box of ODSP, CPP disability applications. And then we're going to talk a little bit about budgeting. So budgeting for accessibility, all that kind of stuff, and then mindset and advocacy and how to ask the right questions. Because there's so many times that whether we're sitting down with a financial professional, whether we're sitting down with a lawyer for ODSP, whether we're sitting down with a doctor, a real estate agent, how do we ask those proper questions so that we can advocate for ourselves and what we're thinking and what we want to know about it? Because if we were to look at it and go, how many people on this call tonight didn't know about disability tax credit or RDSP or anything like that because we've never been shown how to ask the right questions. And so many people aren't going to, unfortunately, one of the things I learned in my tenure, I spent 3 months at the Ottawa Hospital Rehab facility. And one of the things I learned is that if I don't ask and advocate for myself, nobody's going to advocate for me. So we're going to chat a little bit about that. And I hope you guys know that, I'm here and I'm in your corner. I do RDSPs is one of my biggest spots of business. I go by the inclusion strategist. And the reason I do that is because I focus on inclusion for people and family with disabilities, as well as I run a small charity in my town of Carleton Place, Ontario, and it's for people with intellectual and developmental and physical disabilities. And essentially, what we do is we have a soccer team, which is pretty cool. We get people of all ages, all abilities on the soccer field, and then we do stuff in the community. So a couple months ago, we went to the fire station, got to meet, a lot of the firefighters, that kind of stuff, and like in oh my goodness, it'll be a couple weeks now. We are going to CNIB, which is the Canadian National Institute of the Blind, their guide dog center, which is in Carleton Place, Ontario, and we're going to get to see how they train guide dogs, how guide dogs can support everybody. So what with that said, here's my information. Please send me an email, call me, text me if there's any way I can support you with anything like this. This is my website, talks a little bit about my story, and what I do, my charity, that kind of stuff. But if there's ever any way, I can support you, that's what I'm here for. For me, I want to give back to my community, and I'll be very open and honest with people. Like I said, I write a lot of RDSPs, and I don't know in my life if I've gotten paid over $100 for the RDSPs, which is, we don't do it for money. You know what I mean? And it's about how we can help and getting to see that impact on people's lives. I look at my own $4,500 to $26,000. Crazy. I look at that gentleman, $1,000 to $19,000. I have a 9-year-old boy that has $67,000 in his RDSP. 67,000. Like it's beautiful. It's beautiful. So I appreciate everybody, being on here, chatting with us, writing the questions in the chat. And what I'm going to do is I'm going to open up. I think Brett is going to read the questions to me, and I will answer as many of them as I can. Whatever I don't get to, I will I'll take away. You can reach out to me, send me a message, and I'm happy to answer any questions you have. And if I need to take anything offline, we have three more sessions that we can answer them next time with. So I've got my pen and paper here to be able to take some notes on questions. So Julie, Brett, whenever you're ready, I'm ready for them.
Awesome. Thank you so much, Sean. That was a great presentation with a lot of amazing information. So Brett, do you want to read some of the questions that are in the chat?
Sure. Um, Here's the first question. Can I transfer money in my current RRSP into my RDSP without penalty?
That's a really great question. So there's a lot of that's a really great question. So that is something that truthfully I did one last week. So we are just waiting to hear back if there is going to be a penalty or not. We did we did reach out to CRA, all that kind of stuff. Um, the one the way I and here's how I look at it. TFSA, yes, no questions about it. RRSP, when it comes to penalty, the only penalty would potentially be taxes, and it would be classified as taxable income. So if you were to take out 5,000 from your RDSP or your RRSP and put an RDSP, it would be classified as taxable income. What we're waiting to find out is if there is that lateral transferability, and that's something that I'm hoping by the next presentation I'll have an answer for you from experience. We did not get a clear answer from CRA, which is truthfully really unfortunate. But the way I see it is when it comes to penalty would be the taxes and taxable income. With the disability tax credit, you would be getting a lot of that back on your taxes that year, though, if they do tax it, if that makes sense.
All right, second question. Is it advisable to have an RDSP with a broker as opposed to a bank? We've discussed this,
And
Sean, and I think you've got the answer.
yeah, in my opinion, you're looking, and what we kind of chatted about, and I raised it on here, is that first off, the most important thing is that if you have the disability tax credit and you're able to have an RDSP, open an RDSP. If it's with a bank, if it's with a broker, just open one. It's in your best interest. With that said, when it comes to performance, a lot of times you're going to significantly see there's a couple reasons that I personally say broker. And the reason I say that is one, you're going to get better returns. So I know for me, the companies I use all use high net worth money managers to manage the funds. So BlackRock, Loomis Sales, Vanguard, Fidelity, they're all the ones that handles the funds. So what we usually look at is return like 10-year average returns between 8 and 12%. Yeah, I would have said like 7 and 10 probably about 3 years ago, but the past 3 years have been pretty good in the market. So the other thing is with a broker, you're going to get those, once, twice a year checkpoints, at least an annual touch point, and then to review your stuff. You're part of their, as funny as it sounds, like a lot of brokers, especially if you have a broker that's not massive and doing millions, like hundreds, millions, billions of dollars, you're essentially part of their family, right? And not in the way of you're part of their work family. And a lot of brokers look at that very seriously because how brokers get compensated is they are compensated based on growth. So No broker is going to sit there and be like, hope their money doesn't do anything this year. No, the brokers get compensated based on growth, which is pretty cool. So with that said, you're not a number. You're getting annual checkpoints at the very least if the broker's a good broker. Um, you're getting better returns, just like I said. So with a broker, the returns that you're getting go into your account. So if you're getting 8, 9, 10, 11, 12% return, that's the number that's showing up on your account. At a bank, I won't specifically call any of them out, but at a bank, if you are essentially, if they said they're going to give you 2%, those funds could return 18% that year. You're getting 2. So when it comes to what's in the best interest of you, I always think it's smarter to get your money working hard for you. You work hard for your money. So whether it's an RDSP, TFSA, RRSP, RESP, first home savings account, anything like that, um, a broker is highly suggested. It's kind of like a mortgage broker in a way too. If you're looking at getting a mortgage, if you go to a bank, they're essentially going to go and tell you a rate. And what's going to happen is when you go to switch banks 5 years later, the new bank is going to give you a slightly better rate that your bank didn't offer you at renewal. And then the bank is going to undercut that new bank just to keep you as a client. But why didn't they let you know that before? So if that makes sense, and a mortgage broker can go and they can look at 25 different lenders and stuff like that. So I know for myself, I have access to 57 different product providers. So it's not one of those you're trying to fit a square peg into a round hole. Every person has different needs, even with their investments. Some people don't want any American right now, right? Some people want all Canadian funds or a little bit more global, but no American. I'm seeing it very commonly. Some people want environmentally, socially good funds. So there are different companies that specialize in those different funds. So long answer to your question, but I would highly suggest a broker compared to going to a bank. But again, the most important thing is just having one open.
Another question regarding the RDSP. In terms of grant eligibility, is that based off family income or the individual income of the disabled person?
So it is family income. The family income for the grant, I was just looking up this the other day, is I think it's just over 100,000 family income. But essentially, how it goes is it's not like ODSP with the $40,000. Where ODSP, if you have $41,000 in assets, your ODSP is gone. Where in RDSP, if you have $1,000 more than you would get for the maximum, it just slowly tapers off. It's the same with the bond.
We have one question about someone who sustained an L1 burst spinal fracture. They're wondering if they would qualify for an RDSP. Obviously, it's not exactly something we can answer. That's a medical professional, but
Totally.
John, advice there for this listener?
You know what I would do is I look at it and a couple things. One, it doesn't hurt to try to get your disability tax credit because many times, whether it's the spinal fracture or it's you have anxiety, depression is something that is very, very common for disability tax credit. More and more common these days. ADHD, all that kind of stuff is very common for. And essentially, if I can give, if there are secondary, so like let's say spinal cord injury is the first injury. If you do have secondary challenges that you face in life, always put them down because the more the more challenges that you face, the better chance that you have of, being able to be eligible for the disability tax credit. But I would say absolutely give it a try. Most and this is just being from what I've seen, most doctors to fill out the form for the disability tax credit usually charge between $50 and $200 to fill out the form. One of the things I did want to mention is that where in the here it is medical expense tax credit, you can actually write off that disability tax credit application under this, which is really good to know. So if you do get it for $5,200, keep your receipt because you'll be able to write that off. But most definitely apply if you can. And it could be one of those things where they give you the disability tax credit for 3 years and then it's a review. And that'd be amazing. Like even if you get 3 years of $1,000 in RDSP and then up to 3,500 in 3 years, you could have $18,000 in there that you wouldn't be able to touch for another 10 years after that. But you could at that time be looking at $25,000, $30,000 if it's invested properly, which is really cool.
We had one question in the chat box about whether you would automatically receive the Canada Disability Benefit if you have the Canada Disability Tax Credit. And I answered no, there's an online application that's very simple. So even if you do have the disability tax credit, you do have to apply for the Canada Disability Benefit. Again, it's an easy online application or you can go in person. So that's something to definitely consider to fill out. And it's also retroactive too. So
And
definitely worth applying to.
yes, and you're automatically eligible with the
Yeah.
disability tax credit.
Yeah.
If, and this is probably past, so this is probably not even worth saying. If you were a person that had the disability tax credit when they opened this up, there is a very good chance they automatically did it for you. So, like, I know for myself, I didn't apply for anything, it just got automatically done for me. So, but disability tax credit makes you eligible. And that's kind of why I put it in the presentation as the master key. Because as you can see, RDSP, Canada Disability Savings Bonds, different stuff with ODSP, the medical expense, like it just gives you access to everything.
Sean, I'm not sure if you have knowledge or advice on this, but their biggest question is how can my wife claim the Canada Caregiver credit? I know there's two lines for if you're under 18 or over 18. There are some more eligibility requirements to that. Is that something you can speak on?
Yes, so that I don't have thorough knowledge on it, but I do know a little bit. So, from my knowledge that I do know, you would need a medical professional to fill that out. So, your wife could most definitely claim that. It would be so. Here's my suggestion, at least, if that's something you're looking at, go online, find the caregiver, the caregiver credit form, and download on the Government of Canada's website, download the application, and then go into schedule a time with your family doctor. Again, you can reach out to me. We could take something like that offline. Not something that I see or do every day, but definitely something that's really important for some people, and that can be really beneficial, which is amazing. So good for you for asking those questions.
That's it for questions. I have a couple comments in here.
Awesome.
Would anyone like to raise their hand to ask? Oh, we, um, no, just another comment. Um, does anyone have additional questions? You can raise your hand and ask live or add to the chat box. We have a couple more minutes here.
And there were great questions tonight. And it's true. Like and here's where I'm going to challenge you is that um, there's going to be questions that you probably think of in 20 minutes from now. So reach out to Brett, reach out to Julie, reach out to myself. If not, we have 3 more sessions. So what we and I'll take this offline with Brett and Julie, and maybe we can do a quick 5-minute recap at the start of each of our next sessions about what happened the previous, see if there's any questions, do a quick Q&A, and then jump into the next that day's session, if that works. Because I know for me, I always have questions as soon as everything's done. So never can get them live. So I think there's been some great questions tonight, some great involvement and feedback, and it's been a true honor to be here, and I genuinely look at this opportunity to be able to speak to all of you as an honor to be able to give back to my community. And my one thing that I would say on a personal note is just keep going. You know, stuff is life can get tough, and obviously having a spinal cord injury adds on to that. But just keep going, because there's brighter times in the future. Who knows what those brighter times will look like? But there is some brighter times, and just keep going. You got this.
Thanks, Sean. And absolutely, we could do a 5-minute recap. And as I mentioned, anyone who's registered for this will be getting a follow-up email with a link to this recording. So, and we will post them on our YouTube page as well as our Core page. So if you're unable to make any of the next sessions, but you are interested, I think within 2 weeks is when we'll have them posted onto those 2 websites. So check back. In the follow-up email, we'll also put Sean's information. So if you're not able to write it down at this point, no problem. That will be in the follow-up email. And I just, want to thank Sean for all the great information. I don't know if anyone noticed too, Brett had put in the chat box, which again, we can put in the follow-up email, the link of where to go to see more information on the types of medical, I think, things, right, Brett, that you can apply for, or that you can put towards your taxes. Some of the medical.
Yep, for eligible medical expenses, CRA has a good searchable list. Unfortunately, it did not mention anything about personal protective equipment. I did a quick little search there, and they said if it was for something like preventing COVID, that it's treated differently than, if you're using gloves for other reasons related to spinal cord injury. So that's something perhaps you'd have to look into yourself. But yeah, there's a list there. And it's in the chat box. Julie and I can include that in the follow-up email because it's a great searchable tool.
Yeah.
And one question was, will we automatically receive the link for next week? No. I entered in the chat box next week's registration. So if you go on our SCIO website, you can register there. Session 3 and 4 are also on the website. So I recommend signing up for all, and then you can receive that link.
Perfect. Thank you all for joining us. Thank you again, Sean, for taking the time to explain some of these things and give your information so that if anyone does have any questions after the fact that we weren't able to get to, then they can contact you. So thank you for that. And hopefully we'll see you all at the one next Monday at 6:30.
Looking forward to it. Thank you guys so much for your time, and
Sean.
hopefully you learned something today.
Absolutely. Thanks, Sean. Thank you, everyone. We will be closing the Zoom. All right.
Bye, guys.
Take care.